Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 140th CP program organized by AASB of ICI for this council year. As we all are aware that we have covered all the sectors, so today we are going to cover very important sector, that is the ESG. So we are going to cover key considerations in the audit of ESG sector. And in order to tackle this very important sector, we have two eminent learned speakers with us, C. Raman Taneja ji and Madam Priya Dugal ji. So on behalf of AASB of ICI, I extend my warm welcome to both the learned speaker. Welcome to you, Raman ji. Welcome to you, Priya ma'am, on this AASB Zoom platform. We are having with us two young moderators, Shri Shan Arya ji and Madam Nikita ji, who is going to moderate today's webinar. So I also welcome both the moderators of today's webinar. And I also welcome all the participants of today's webinar. So before wasting much more time, I request Mr. Shan Arya to please start the proceedings of today's webinar. Over to you, Shanji, please.
Hi everyone, thank you for taking the time out to attend this webinar. So as Anilji mentioned, today's webinar would be on key considerations that are involved in an audit of ESG. So Mr. Taneja and Mrs. Dugal will be walking us through the various ESG reporting frameworks and what the key considerations that are involved in the audit of ESG. So first, I'll give a brief introduction about Mr. C. Raman Taneja ji. So he is currently working as an ESG reporting specialist at Nokia India. He's a chartered accountant and an MBA with over 20 years of post-qualification experience. Mr. Taneja has successfully handled multiple transactions and applied IFRS and Ind AS during his previous roles at renowned consulting firms. He has also advised various clients on transaction structuring and gained valuable experience as a financial controller in the banking sector. Additionally, he is a co-opted member of the CM and IB committee of ICI and was recently honored with the CFO Next 100 award for his significant contributions to the finance community. Mr. Taneja is highly passionate about ESG and will be sharing his insights and experience on various ESG reporting frameworks. Now, I would like to invite my co-moderator Nikita to introduce our second speaker.
It is my pleasure to introduce CA Priya Dugal. She is a chartered accountant and has done her BCom in Accounting and Finance from Mumbai University. She is a director with a strong record of over 20 years of experience of successfully delivering efficient and effective quality audits across various financial service entities, including bank, NBFCs, broking firm. In recent years, she has shifted her focus on delivering integrated reporting sustainability related assurance services and accordingly has been involved in several assurance engagements in financial services and non-financial service entities. She has led sustainability assurance engagements for many entities. She has headed advisory engagements under the IARC framework on integrated annual report for large listed financial services entities. She has been involved in engagement related to CSR financial review of funds utilization and management of funds, including accounting by the NGOs. She possesses experience in reviewing internal financial controls over financial reporting under the ICI guidance, like the COSO framework. Today, she will be sharing insights on the key considerations in audit of ESG. Now, I would like to introduce and invite CA Raman Taneja sir to start the deliberation.
Sure. Thank you so much, Nikita, and thanks, Sean. I'm just sharing my screen. Let me know once it's visible for me to get started.
Yeah, it's visible.
Okay, great. Hi, everyone. Very good afternoon, good evening to all of you. I'll be starting and taking everybody through ESG and ESG reporting frameworks over next 45 to 50 minutes. The agenda for this presentation today looks like as they're on slide. We'll start with understanding ESG, what ESG is all about, and how ESG reporting has evolved. And also talking about certain reporting landscape which are already in existence for ESG reporting, both from a voluntary to mandatory reporting frameworks. Then we'll go through certain reporting standards and frameworks. The intent here is to cover almost all those reporting standards and frameworks which are in existence today, be whatever part of the world, for us to see how they are different. Then we'll go through BRSR, which is India's ESG reporting framework. And the last section relates to strategy to implement ESG reporting. What kind of steps companies need to take? How do they really implement ESG reporting within their current reporting systems or financial reporting systems? Let me start with the first topic, which relates to ESG and ESG reporting. As you all would be knowing, ESG, so ESG stands for environment, social, and governance. Broadly speaking, I would say it is a framework that is used by various organizations across the globe to measure how they are performing on sustainability related matrices. That's broadly, to put it this way, that ESG is about all those three areas, which is about governance, social, and environment. So these are three areas and also cover various ethical issues. We'll deep dive on these step by step, but let's first understand from ESG to what ESG reporting is all about. So ESG reporting is about communicating or sharing how companies have progressed on three parameters, which I mentioned in my last slide, which is environment, social, and governance. How companies have got their targets and how they have achieved on those targets. So communicating those progress on those targets is about ESG reporting. Then what kind of information companies are required to disclose in ESG? So primarily it is a non-financial information. Like we all see, annual report includes those financial information related to performance of a company, profitability of a company, about its financial position. ESG is about those non-financial information. They may not be directly linked to financial statements. They may be linked to any other KPIs. We'll understand those in a short while. What could those KPIs be? And then what kind of metrics it's actually includes. So they include both quantitative metrics as well as qualitative metrics. Quantitative metrics, I would say, relates to disclosure in numbers, disclosure in tables, for instance, related to GHG emission as a simplified example. And qualitative relates to narratives as to what is company's strategy on ESG and how they really want to build on those strategy, linking strategy to overall of I would say targets, and then linking targets to what kind of current policies companies have to achieve those targets. So it's primarily about end-to-end disclosure from qualitative to quantitative. And we'll see in various frameworks around the world as well as in India, there is a mix of quantitative and qualitative information which are required to be disclosed, which actually varies across various frameworks we'll hear today. Another important piece is the kind of importance that ESG reporting has gained over past few years. And mainly because most of the stakeholder group today are interested to see how companies have been performing, how ESG have been embedded into their business operations, how ESG have been embedded into their strategy, how they're working together to make sure that ESG is a core metrics of the company. So that's why most of the stakeholders around the world are looking for ESG related information to be shared by them. So the example of disclosures, as I mentioned in my last slide, relates to both quantitative and qualitative. Let's understand how these disclosures differ from a quantitative to qualitative. So quantitative disclosure, ideally in an environment, the first pillar of ESG is environment. It could relate to climate change. It could relate to GHG emissions, energy efficiency generated by the company. It could relate to waste management. How much waste is generated, how much waste is recycled, how much waste is in landfills, how much water company have used, how much water has been reused by the company. So those are a sort of quantitative information. It may be in either form. It could be number form. It could be in percentage form. So either ways it could be disclosed. Likewise, the second pillar relates to social standards, which talk about what are labor standards in a company. For instance, how much health diversity, what is the diversity of employee of a company, what kind of investments companies have done to community, what kind of funds have they invested, how many people have been affected by way of a community engagements that they are carrying out. What are various working conditions in a company? For instance, are employee given leaves? Is everybody given leaves in time? Are all employees given leaves in a timely manner? How about parental leave? How about all of the different kind of leaves that employees are offered or given? Does all the employees avail those leaves or not? So it's about those quantitative information. And then the third pillar relates to governance, which talks about the diversity at the board members, which talks about how many cases have been there against the company, how many social issues have been there against the company, what is pay gap ratio between the CEO of a company or a highest paying employee and the lowest paying employee, how many cases have emerged out of bribery, out of corruptions. So those are the kind of, I would say, quantitative disclosures, which are required. Just few example of those for you to understand what kind of extent of disclosure it could be. Then moving to qualitative disclosure with respect to environment, they could relate to the policy, they could relate to strategy, they could relate to product development, how companies are spending in developing their products so that their products consume less energy, where all they have invested in developing those kind of products, what kind of steps have they taken to manage waste in the company or water reuse. So these are primarily about qualitative or narratives or explanations that they need to give. Likewise, on social, what has been companies' policies on human rights, diversity, working condition, how do they balance all of these aspects? And then companies' policies on maybe bribery, corruption, or how a whistleblower policy is structured in the company. So it's about disclosing all of these aspects from both quantitative to qualitative so that there is a comprehensive view that investors and the stakeholders can develop about a company. Okay, now while we all understand ESG, but the bigger question is, where is it actually starting from? So it's starting from the increased environmental issues that we have been facing over past few years. And one of an example is what's on screen. Is a warning that was given by IPCC. So Intergovernmental Panel on Climate Change keeps on publishing a lot of those data and information around how we are progressing. So this is the most recent one that they published in 2021, whereby they clearly mentioned that if we don't control carbon emissions, we might end up having a 4-degree increase in temperature somewhere by 2100, or maybe 2.5 degrees of temperature increase by 2050, which is alarming. At the same time, the kind of carbon dioxide which is being released has also been increasing significantly, contributing majorly to that factor. Um, and and for information, and we all should know actually, the carbon dioxide that's being emitted today stays there in the environment for almost 95 years to 100 years. That's the lifespan of a carbon dioxide. Hence, these increased environmental issues that's being faced today because of frequent changes in the pattern of rain, frequent changes in heat waves, droughts happening everywhere, melting of glaciers, there is an increased need for something for companies to measure how they are progressing on environment. At the same time, while this is coming because of the recent issues being faced, at the same time, what we also see is that most of the leaders of the world are very much vocal about these issues, and they have started taking significant actions. Recently, I was attending New York Climate Week. It's happening in New York right now, whereby they are they are inviting various speakers talking about how we are progressing on climate change, what kind of regulatory frameworks are there. So I get to hear two of those speakers, and you could see that the gentleman in the first picture already mentioned and saying that ESG might be a big word. It might be I would say, a buzzword. However, it's more about converting those buzzwords into various actionable items that companies need to take. At the same time, if we don't report, we don't control it. So that's why efficient reporting is necessary to have transparency. Similar kind of results we have seen in another global company, whereby they are having a zero net waste because they started measuring much before, much ahead of time. and hence they have already cut significant amount of carbon emissions out of their processes, out of their value chain. So that's how things are progressing. At the business side, I would say there is a huge focus. All the organizations are laying significant, I would say, focus in towards ESG reporting. With that, let me move to another information which relates to SDG. We call it Sustainable Development Goals. I'm sure all of you would have heard what SDGs are all about. We have been hearing these in COP events which have been happening. One was recently held in India as well. So it is they were they were established in 2012, and the objective was to have a framework, at least certain goals which all the countries need to align with. And in the Paris Agreement in 2015, almost all the countries adopted and said we all commit to maintaining 1.5 degrees of global temperature rise to make sure that it doesn't happen beyond 1.5 degrees by 2050. From corporates, from countries, it's drilling down to individual companies now. India is also committed to it. 2070 is the year when we are saying we'll be net zero um, carbon emission country by 2070. So there are 17 SDGs which are broadly divided into these 5 pillars. And these SDGs actually form the basis of, I would say, almost all the frameworks that we'll talk about today. So be it related to poverty, it relates to education, it relates to automation, it relates to sustainable products, it relates to social factors, it relates to water, everything. They all are being covered by these SDGs, 17 SDGs which are there today. Okay, so with this, let me take all of you through is what is actually the importance of ESG reporting. So there are 4 things which I would say are most important for ESG reporting, which they'll add value to. One is they'll do increase transparency, increase trust, increase communication between the company and the stakeholders, whereby the stakeholders would get to know how companies are performing in ESG related matters, how serious they are, and what's been their overall commitment to it. It helps to manage risk by the companies. It helps the companies to look at what could be various risks that they might face, whether it's climate, whether it's social, whether it's governance, and how should they really develop resilience toward those risks. What kind of business continuity plan they should develop so that their businesses are not impacted. The third one, it creates a very positive brand image of the company because companies is very much committed to a sustainable practices. So very positive brand image that company gets to develop. And at the same time, increase investors' interest, which we have seen recently with all the green bonds that's being floated in the market and the kind of interest which we have heard. It is definitely going to go ahead and the values are going to increase, the commitment is going to increase. And likewise, investors are also going to have a lot of I would say interest in ESG reporting of companies. Okay, so well, when I was working on these slides, I thought all of us are from financial reporting, but at the same time, we need to understand what's actually difference between an ESG and a financial reporting. And I found this really good summary which talks about financial reporting and sustainability reporting. A very nice which actually states um, on what basis financial reporting is focused and on what basis sustainability reporting or ESG reporting is focused. For all of your information, sustainability and ESG are synonyms. They are being used synonyms or similar words. So I might use them in my presentation going forward at some point in time. So you can consider them same. So in terms of time scale, the financial reporting focuses on the year. However, ESG is more about future oriented, the strategy of a company, the contribution to environment, climate, and the resilience of a company. The focus of financial reporting um, is mainly on issues that organization directly controls. However, for ESG or sustainability reporting, it's a wider, I would say, environment related topics, wider societal topics. Then economic views, material, these financial reports are mainly based on the material factors, while sustainability reporting may be based on material as well as intangible, but broadly these are intangible factors as to what might happen in future. ESG reporting is more of a non-financial. We'll understand them how they are non-financial. And then financial materiality, financial is more about what is the financial materiality, and ESG is more related to one more term, I'll call it double materiality, which is financial as well as impact materiality. Then the users are very broad in sustainability or ESG reporting. They are more targeted at stakeholder. It could be government, it could be NGO, it could be anybody. Well, and then few more differences. First one relates to the unit of measurement, because unit of measurement in financial reporting is broadly constituted around maybe I would say currencies like INR, Euro, or maybe in dollars or maybe any other currency. For sustainability reporting, it would vary from disclosure to disclosure. Something could be number, something could be in percentage, something could be in gallons, something could be in kilowatt hour. So that kind of unit of measurement changes from disclosure to disclosure, and that's the complexity that ESG reporting creates. The second one is about value chain reporting. Financial financial annual reports are all about consolidation of a company, of overall group entity. Sustainability reporting is about adding value through entire value chain, and I would say both upstream and downstream. Both the ways are covered here with respect to entire value chain benefits or value addition that we could do, that companies could do. The third one is the materiality. I've covered this in a subsequent slide, which I mentioned before also. It's more about financial materiality. ESG is more about double materiality. And then the regulatory framework, which is a lot more different. This diagram actually states the stakeholders. So stakeholders are not just investors, they are not just regulatory authorities, they are not just employees, but they are more than that. Every competitor, every civil society, every value chain partner is a stakeholder for company or undertaking who does an ESG reporting. Okay, my this slide focuses on double materiality. As I mentioned before, ESG is focused more on a materiality, which is not just a financial materiality, but also impact materiality. So there are two decision that company need to do. First is it need to see which are those factors that contribute to impact materiality. And when it says impact materiality, it means inside out. So whatever actions I as a company undertaking are going to take, how does that impact environment? So if I have significant GHG emissions happening from the company, how are they negatively impacting the environment? That's inside out materiality. And then the outside in materiality that relates to whatever emissions extra I've done, how much extra cost or how much impact that could do on my overall financials. So for instance, the company might be impacted because of significant change in weather conditions, and its revenue might go down, its cash flows might be impacted. So what are the impact of those on the investment on the companies? Because certainly that's going to increase in prices of certain products that company buy. So how does that really impact the company? So that's why the company need to consider both impact materiality, which is the impact on environment, impact on climate, impact on any of the social factors, and then the financials, what kind of impact it creates on the financials of the company. And they have to be done in both, in all current term, which is a short term, could be medium term, maybe 3 to 5 years or 7 years, and then long term, 8 to 10 years or more than 10 years time horizon. With the first section, now I go to second one that relates to evolving ESG reporting landscape. So evolving ESG reporting landscape primarily focuses on how reporting landscapes are developing. What you see on the left hand side is a voluntary metrics. Most of these frameworks are voluntary, almost, in fact, I would say all of these frameworks are voluntary today. Companies decide to report because of their own will that they want to disclose these, or they have investors representation saying they want companies to report on these, and that's how companies have started these voluntary practices. However, over time and over last couple of years, we have seen that these are slowly and gradually moving from voluntary practices to what we call a mandatory multi-stakeholder focused. So the focus is not just on investor, focus is on all stakeholder. The focus is not just on voluntary, it's on mandatory, whereby companies would be mandated to report all of those KPIs related to environment, social, and governance factors. These are few of the regulations which are mandatory around different parts of the world, and they have been mandated across different time frames. So there is a I would say transitional provisions that have been included in almost all of these framework, allowing companies to develop to have a system for reporting. And one important piece here is related to assurance, which Priya would talk about in the second session in a couple of minutes from now. But the assurance have also evolved. From what we saw voluntary, the assurance pieces have also been to reasonable assurance to limited assurance. So those are the kind of evolutions that have also happened because companies have started mandatory reporting. There is a strong need to avoid greenwashing. We call it greenwashing with respect to those domain whereby companies report on certain factors which they have not achieved. So it's like reporting a false information in the ESG reports. So an assurance is really, really an important part of it. These are just few ESG requirements, how they've accelerated around different parts of the world. US started with the rule on climate disclosures. It's still in draft phase, and we'll go through that framework. Likewise, it's mostly borrowed from TCFD framework. California has already notified climate-related bills, which is already, I would say, mandated there. Only 4 companies listed in California, and maybe few companies which are there listed in the other parts of US. France has already got water, natural resources, biodiversity-related regulations. Germany has got regulations on due diligence. Norway has similar requirements. China recently had all the three different stock exchange adopted ISSB related standards, and then EU, which consider itself to be forefront runner, have got regulations almost, I would say, every part of these. In fact, India is also not far behind. India has also have regulations on battery waste management, on all those conflict minerals. India also have started and have got all the regulations around these. Um, One piece that we really want, which we all should understand, is what kind of impact a voluntary to a mandatory reporting does. So it actually has a very, very big impact on an organization. So from a voluntary reporting, whereby only few de facto frameworks were applicable on those companies like GRI or SASB, companies have started to move to mandatory ESG reporting, which required specific frameworks to be disclosed, specific information to be disclosed in the ESG reports of the company. It used to be standalone report. Now companies have adopted integrated report, which is through integrated reporting framework, which includes both linking financial as well as non-financial information. There were only few teams which were required since it was a voluntary framework. Only few part of the organization were required to work on it. Today, it's a cross-functional organizational efforts that have to be there. And also board of directors have to sign those reports, which means they're responsible for it. Internal control framework also needs a significant development and change in process because of different KPIs, because of complex reporting, to avoid greenwashing, to make sure that information that's being reported is adequate and correct. And then the consolidation of data, because it's a comprehensive report requiring various disclosure from E, S, and G factors, and also for value chain reporting, it's necessary to have some tools and technology in place to consolidate these data and information. And then the last one is about assurance, which will be covered by Priya in the next section. With this, I would like to move to interesting part of it, which is ESG reporting standards and what are different frameworks around the ESG reporting. So these are few of ESG reporting frameworks. SEC we already talked about, and see it's there in the US. In India, SEBI has already mandated BRSR report. IFRS Foundation has already got ISSB, International Sustainability Standards Board, which have published S1 and S2. We call it IFRS S1 and S2 standards, which are being adopted by various countries. Just a couple of days back, Hong Kong has recently adopted these ISSB, which is IFRS S1 and S2 standards. Just before that, few other countries within Asia, Australia, and all of those have also adopted, and they've got guidance around when should they apply to different listings or the volume of the companies. Then is the TCFD, which is actually merged with SEC broadly, and with ISSB, we have value reporting framework, which is SASB, which is more to do with sectoral analysis, and IIRC, which is more to do with integrated reporting framework. Uh, and the last one, GRI initiative, which has been, I would say, pioneer. They started this ESG reporting standards. The first one, they were the first one to publish them and suggest what should be reported. It started somewhere in 1997, so almost more than 3 decades of these GRI standards being published. Over next few slides, I'll be going through each and every of them for you to understand how they are similar and how they are different, and how audit approach would vary accordingly. So as I mentioned before, GRI was launched in 1997 by it's a joint initiative of United Nations as well as CERES. That's how they started. They gave a guidance for organizations on all of these, I would say, voluntary standards. They also relate to they are also sectoral standards. There are general standards, as we have seen in IFRS and Ind AS as well. And then the most important thing is the traditional approach that they've skipped. It goes much beyond that, because their focus is not only on financial requirements but also on broader on all the environment, social, and the environment economic factors as well. Again, it focuses on multi-stakeholder, not just on investors, but on multi-stakeholder, on all the broadly stakeholders who will be interested in getting this information. And then the third one relates to a common stakeholder approach, which means that the content is have to be disclosed with respect to all the standards very clearly and in a very structured format. We'll have a look at one of an Indian company which have done that. In fact, many Indian companies are doing that. If you look at integrated report of many listed Indian companies, they're already publishing and mentioning in their integrated report the GRI standards, the SASB standards, and how they are, what kind of KPIs have they accomplished there. So to develop your further understanding, GRI standards are classified into 3 buckets. One is the universal standard, which I would say are general standards. They talk about the requirements, applicability on the organization, etc. The sector standards, which talks about specific sectors to which that organization relates to. So the companies have to disclose on those specific sectors. And then topic standard, they relate to topic like environment, social, which are mapped to SDGs, mostly mapped to SDGs, almost all of them. So companies have to select those all respective standards and disclose. So what you see on screen right now is something coming from a listed Indian company. They have disclosed GRI2. They have started with GRI2, which is, I would say, a general standard, general disclosures, and most recently published, updated in 2021. You can see that their disclosure varies from organization to strategy to governance. Um, Governance is more to do with how companies manage sustainability related practices. That's more related to more governance. So that's governance with respect to ESG. It's not the general governance of an organization, which normally companies always disclose within corporate reporting in annual reports as part of corporate governance section. So this is more to do with governance of ESG related disclosures, and who all are in the company who looks after those governance related factors. Then is the strategy as to how company focus on the strategies and policies. Then talks about environmental. They have given specifically environmental related disclosures. Moving ahead quickly, I'll move to the next slide, which is SASB. SASB has got industry-wise sector. They have specified 77 sectors, and again they also focus on financial materiality. They focus on those which are separate industry-wise guidance available, and definitely a comparability and reliability is one of an objective. So coming to SASB, this is one of an example as to what kind of standards they have developed. For instance, for energy-related sector, it covers primarily greenhouse gas, it covers renewable energy, RE100, it covers energy efficiency. Relating to materials, it covers around resource extraction, waste management, around life cycle management of products. And on the consumer goods, it talks mainly about supply chain related factors as well as social factors. With GRI and SASB, who have been pioneer in this field, we now move to those standards which have recently been published over last couple of years. I would say in last 2 to 3 years or 4 years is what have been published. So the first one is SEC, Securities and Exchange Commission, have published their standards which relates to climate risk and opportunities. Very much draft in stage. They published in the month of March to be applied by US listed companies. However, they had to withdraw because of uh, because of the concern raised by the industry lobbying authorities. So they had to withdraw. We'll have to be hopeful when they are being published again. However, at this moment, there is no regulation in US. It's completely, I would say, at this moment, optional for companies who want to go for it. At the same time, California is the only state in US who have published a climate-related factors or climate-related regulations to be published by companies. IFRS, or I would say ISSB, have published recently IFRS S1 and S2. IFRS S1 is a generalized standard. It focuses more on what should be there in the report, just like I would say in the S101, just like IFRS 1 or IAS 1. It's a generalized kind of a standard which lays down all the principles, all the requirements. And S2 is focused on climate related risk and opportunities. Again, many countries of the world, many companies of the world have started adopting ISSB as the framework for them to report sustainability reporting or to be included by them in their sustainability reports. The third one is EUCSRD, or I would call it ESRS. CSRD is Corporate Sustainability Reporting Directives, and ESRS stands for um, they relate to sustainability reporting standards, European sustainability reporting standards. We'll go through them in a short while, but they are again very wide. They not just cover climate, they cover all the aspects. They not just cover risk and opportunities, they try to cover impacts as well. Action items, policies, targets, very, very broad. I would say CSRD have covered, it's a combination of both, but SCC, what ISSB says, I would say it's to that extent broad. With this, let's dive into all of these one by one. So SEC climate related disclosures have got these, and this is specified in SEC regulations, the draft regulations. Focus is on governance as to how companies manage ESG related risk and opportunities, primarily climate. Who are there in the company, who are focused, who are involved in taking those decisions, and who are involved in advising or guiding the company internally? What kind of decision do they take towards climate related risk and opportunities? It's about risk management. What kind of systems they have, how is risk management of a company embedded in overall risk management strategy. So ESG risks and management, ESG risks, I would say, merge with uh, uh, enterprise wide risks and opportunities. Then on climate related risk, what are material impacts of those climate related risks that have happened or they're going to happen, how companies are managing their climate related risk and opportunities, what kind of impact it could have on revenue, on assets and on assets and I would say investments of the company. So how are they managing these all investment related risks and opportunities? It could be opportunity as well. For instance, for those companies which are into IT sector, they might end up developing software which which is created through AI, which helps in saving electricity, which helps in saving power consumption, which helps in making products more efficient. So that's an opportunity as well for companies. The last two relates to metrics and targets. Metrics is similar to what we have in our financials, in our annual report. Similar to it, what kind of KPIs have company accomplished, both for scope 1, scope 2, scope 3, GHG emissions, whatever emissions companies have done by itself, through purchase or through its value chain. So that's scope 1, 2, and 3. And then targets at the end. What were companies' climate related targets and how they are accomplishing those targets? Similar broad thing is in TCFD, which is also same. Focus of TCFD is to focus on is to report on the climate related risks and opportunities and also financial quantification. If you see, they are broadly the same. So SEC has primarily adopted TCFD, and likewise ISSB have also adopted TCFD. This is the TCFD of one of a listed company in India. They have disclosed the 4 pillars, exactly what I mentioned, and these are specific questions which company need to answer and give a reference to those, and explain company strategy, explain how they're going to achieve the sustainable development goals, and what kind of product renovation or innovations they are doing, how they're implementing those in their current systems, how they're working with their supply chain to make sure that climate related risks are taken care. Then I move quickly to what is IFRS sustainability standard. I call it what published by ISSB. you would see again the terminology is same. It's governance, it's risk management, it's strategy, it's metrics and targets. But the difference here is the other ones, SEC rules and TCFD only focuses on climate. But here the focus is on more than climate. So if there are any social related factors, if there are any governance related factors, that also need to be factored and disclosed along with climate. Uh, with this, I move to CSRD and ESRS, because CSRD and ESRS, I would say the most complex ones. They consider themselves to be the complex ones. They are mandatory in scope starting this year for all EU listed companies, and then will be in phase out. It'll be mandatory for other companies as well. Even those companies which are not listed in EU but have a significant value of transactions in the European Union, in the EU area, would also be required to publish CSRD reports. These are 4 parameters on which companies have to report. They need to start with the strategy. Companies need to disclose what policies they have with respect to environment risks and opportunities, what actions they are going to take, and what targets and what achievements they have towards those actions. This is the applicability of CSRD on the companies. So before CSRD, there used to be NFRD regulation in the EU, which was applicable only for few top companies in the EU. From there, CSRD is applicable, which means that the scope is very broad. It is expected that around from 5 to 10,000 companies will go directly to 50,000 companies that will be impacted in the EU, including many Indian companies who have a subsidiary there. Many Indian companies have a branch there. They'll be required to report on the CSRD reporting. So starts with the public interest entities, which are supposed to report starting first year, which is 2024 is the first year. Then it goes to a certain threshold who have more than 250 employees, who have turnover of 40 million or assets more than 20 million. If any of those companies exceed these in 2 consecutive years, they have to disclose these. Then SMEs are also required if they are listed SMEs. And then the non-EU companies, if they achieve some threshold on 150 million euro or 40 million of turnover if they have a branch. If they achieve these thresholds, they'll also be required to disclose and prepare CSRD reports. This is the format of CSRD report. There is no format that we could see in SEC, in ISSB. It's just a principle that they have given. Our CSRD have actually given a format. And these are all the standards in CSRD. Broadly, I would say they cover the general piece, which is similar to what we saw in S1. These are all climate related, 5 topics. They relate to social factors from internally within the company, workers in value chain, consumers, and the communities, and then the business conduct. So companies will have to disclose all of these information going forward in the same template, in the same format that they have prescribed. And now let's we have heard a lot. We're talking about risk, we are talking about actions, we are talking about policies. Let's see in the practical point of view, how does it really gets implemented by way of one small example. So the problem statement here, which I have hypothetically created, relates to GHG emissions. A company says that their GHG emissions are significant and they very much impact the environment. So how do we apply CSRD and other frameworks? Companies will have to sit and say, if my GHG emissions are so significant, what kind of strategy I need to build? So it could have a net zero strategy, it could have a decarbonization strategy as to how do I remove carbon from my value chain, from my company first to my value chain. In respect of actions, the various actions they need to take is to have a connect with the value chain, invest in renewable source of energy, invest in energy efficient products so that carbon extraction, carbon usage is reduced, carbon emission is reduced to the extent possible. That's an action the company needs to take. And likewise, they need to have real policies now. For instance, whenever we do an asset acquisition, whenever we buy any property, plant, equipment, we look at those cases where which are mostly dependent on renewable sources of energy to the extent possible, which have energy efficiency built in, which can be very much synchronized with all software today, so that they start functioning automatically, they stop automatically. That's a kind of policies company need to build and implement this ground reality. They also need to have supplier assessment and selection process, which means that if any company starts to evaluate any supplier going forward for any new suppliers, or maybe even for the current suppliers, they need to start thinking what kind of metrics we need to have, what kind of criteria we need to have for the supplier selection. Likewise for product innovation, plant setup, etc. And then goes deep down to targets. So to measure a GHG emission, we'll say we are net zero by 2030, and we'll measure it. How much of net zero have we accomplished? How much percentage have this been accomplished? And also prescribe GHG related disclosure for scope 1 to 3, and say how much of these percentage have been decreased, increased over last year, over the base year. So that's a broader concept as to how these GHG related issues should be tracked ideally by applying all of these frameworks. Okay, we have heard a lot about what other countries are doing, but for us, important thing is, what are we doing in India? What kind of steps have we taken in India towards ESG reporting? So it starts with this document, which is already published by SRSB of ICAI. If you haven't read, I'll suggest all of you to download this document, spend some time in going through it, because it covers, I would say, all the pieces from environment, sustainability, their rationale, and then what kind of disclosure should be there. But I'll summarize these for information over the next few slides. So it was earlier BRR, we used to call it Business Responsibility Report, which has been replaced by a very, very detailed comprehensive guidelines on BRSR, and it's applicable across all the companies, across 1,000 top listed companies in India by market capitalization, through different phases, which SABI has prescribed. Another good thing about this, about BRSR framework, is that it's adopted through practice, which is already, various frameworks are already having, like GRI, SDGs, we already talked about these. So GRI, Global Reporting Initiative, Sustainable Development Goals, Task Force on Climate Related Financial Disclosure, CDP related to climate development disclosure project, which is primarily related to climate related disclosures by companies, and SASB, which is sectoral standards. So it's very much mapped to broadly almost all of those already established framework, which means I would say it's a mature framework. Although there might still be updates on these, but at least at this moment we are seeing it and considering it a very, very comprehensive framework with all the information being disclosed that covers almost I would say 5 of these frameworks. And then what is also required enterprise, all the companies to report, is the ESG performance indicator and how they've achieved on those. We look at one company, how they are reporting it. It's about applicability and framework. So as I mentioned last slide, in 2023, mid of 2023, on 12th of July 2023, 1,000 listed companies are required. So SEBI published a notification or a circular which mandated all of these companies, and they included BRSR core, they included ESG disclosure requirements and assurance requirements. So BRSR core, I would say, is the center of it to start with. And the entire disclosure are broken into 3 parts, just like similar to what I would say ISSB. It's general disclosures, it's the management processes, which is similar to CSRD, and principle-wise disclosures, somewhat similar to what we have, what we saw earlier on all of those KPIs. And the other part is it's very much synchronized to what we have NGRBC. It's a national guidelines on responsible business conduct, published by MCA recently, a few years back. So there are 9 principles, and all of these BRSR requirements are mapped to those 9 principles, which more or less cover all E, S, and G requirements. So these are 9 principles which all the companies have to state in their integrated report if they are publishing, or BRSR report that they are publishing. They need to have their progress, they need to have the actions, they need to have strategies for all of these 9 principles disclosed therein. This is an example that I was mentioning before. So this company, it's a listed company in India, and they started with a general disclosure talking about company, how many employees companies have, how they are progressing, what kind of revenue they have achieved, what kind of sectors they are hitting, what kind of people they have impacted, what kind of governance methodology they have. Then they talk about processes, how management is reviewing, what kind of governance methodology they have. And then they come to principles, all the 9 principles, including an assurance statement, including a life cycle assessment of products in terms of the product moves through different life cycle steps, and how it is being impacted, or what positive or negative impact it creates with the environment, how it communicates with the environment while it goes through all those different steps of production process of the company. So I've just included 4 of these principles here just for reference. So principle 2, it talks about goods and services. Are they sustainable? Are they safe? How they contribute to green environment? And you could see that they're also linking it to SDGs. So that ways, all of these 9 principles are very much linked to SDGs. They also comply with GRI standard. They have also mentioned the GRI standards to be they are linked. Then they mentioned about 5th principle, which focuses on human rights. It's one of the important topic, human rights, and very much emerging topics. And we see most of those NGOs today getting active. And hence, human rights is something, equality for all, everybody in the company is necessary. So it's one of the most important principle. Then they talk about environment, how they contribute to environment, and how they're achieving net zero strategy in the company. And then the last one, they talk about consumer, how they're contributing to consumers, how they're focused on consumers, and how they're listening to consumers' voice and implementing or embedding it as part of their product portfolio. It's one of an example. You all must read BRSR report. It's going to give you a lot of more information. And then I move to the last piece. We have all heard as to what are different frameworks, what are different requirements around the world as well as in India. But how do companies really implement those? Because at the end of the day, if implementation is not proper, they won't be able to achieve the results that they want to. They won't be able to have proper reports. They won't be able to have reports which are transparent. So companies need to have adequate strategy, adequate steps to be taken by them to achieve uh, these. So this is how the implemented strategy of a company is. Just like just like when we moved from Indian GAAP to Ind AS, we had to do a materiality assessment. We had to look at what are gaps vis-a-vis earlier accounting standards. We had to plug those gaps and have respective processes in the company, develop those policies, think about how to do fair valuation if you are not doing. So implement all those things in the company. Similar thing is in CS, is in sustainability reporting or ESG reporting. That companies need to look at materiality, what all topics are material for the company, applying both impact as well as financial materiality. Of all those topics, environment, social, and governance topics, look at what is the requirement of standard and see what are gaps that companies have. Companies may not have certain policies on any of those topics. They may not have net zero strategy right now. So it's a time for them to build those net zero strategy and then have those plan. How do we implement those net zero strategy within the company? And this can be done only by these 4 pillars, which relates to data governance and which is to governance and management processes that is involving everybody in the company, all the leadership, making sure that everybody understands how important it is for everybody in the company to be involved for implementation of ESG reporting. Because ESG reporting is not just the responsibility of CFO organization, it is the responsibility of organization as a whole. Everybody from production to supply chain to people's organization to finance organization, everybody has to be involved. So all the leaders have to be involved at the right time for implementation of an effective ESG strategy, and then subsequently reporting of those. The second one relates to operationalizing those sustainability action plan as to how do we really implement those action plans, having those further sub steps of implementation and working on those steps within the company first and then with value chain. This would also require having sustainability team within the company. And I have seen companies started hiring chief sustainability officer who are an expert and looking at the entire sustainability strategy of the company because most of investors demand this information today. The third one is the control reporting process, very much linked to finance colleagues here. We can always understand how important is it to have a controlled reporting process, to have an adequate, strong internal control framework. So we used to have ICFR in financial reporting. Now we have internal control for sustainability reporting, which is also to be published soon. It's in the progress. So ICSR is what's going to govern internal control on sustainability reporting. And then assurance process as well, to be done both internally as well as externally. The last one relates to the digitalization. Nothing is complete without digitalization. So a digitalization would really simplify a lot of reporting processes for the company. So looking at the digitalization opportunity, looking at various tools which can be synchronized, which can do GAG reporting. From GAG reporting, it can directly go to ESG report, so that reports are automatically prepared. So these are the kind of investments company need to do from in building those ESG reports. And then at the end, people. It's a change. It's a change in reporting, which requires a collaboration, which requires working together, which requires roles and responsibility sharing within the company, everybody owning their respective pieces. Only then this strategy or ESG can be implemented, or ESG reporting can be effective. Otherwise, ESG reporting is just going to be a piece of paper, which may not add value to many organizations. It's just a demand from investors that company might publish, but at the end of the day, when they start looking at the progress that they've achieved, it might not be that effective. With this, I would like to hand it over to Priya. So Priya, I've covered this piece and now handing it over to you.
Thanks, Raman. And as Raman has covered the regulations in terms of the reporting which the entity will have to do depending on where it is in its journey, in its sustainability journey, whether it's mandatory reporting, whether it's just give me a second, sorry, guys, or it is a voluntary reporting. What is very important is to these regulations, how are they audited? Because that is where it is coming to now. The investor community, the regulators, the international bodies are looking at how credible is the reporting, and the credibility of the information that is reported comes from the assurance element, and therefore what we are trying to cover now is, given that there are several frameworks which we talked about, what is unique in sustainability is there are quite a few frameworks that are there under which the company could report. While in India, there is only one mandatory BRSR framework, there are jurisdictions where there are no mandatory frameworks. So the company has an option to choose the framework under which it reports. And therefore, for comparability to having, and for the analysts and the investor community and the regulators to decide whether the reporting is appropriate. And he also mentioned the word greenwashing to ensure that the information reported is appropriate. Audit is needed, and that is what we are going to cover. In terms of, and it's like an audit of financial statements, because we'll have a lot of financial colleagues here. There is a framework under which we do our audits. That's the auditing standards. Similarly, in case of sustainability, what we're going to cover it, what are the audit assurance standards that need to be followed when you're doing audits of ESG key information or key parameters or identified sustainability information, the way it is called. We'll do a brief overview of the assurance methodology, and then we will cover assurance approach by way of one or two examples given that the time we have, and what are the overall challenges in doing attestation of ESG information. And then we'll go on and finally conclude with questions, which will be covering both the topics. So before we start, what I would like to say is, when we do financial statement audit, it is one piece of the company. It's one of the most important pieces of what the company is reporting, and it has several linkages. And what is ESG is actually quite vast. It is everything other than the financial reporting. So it is both quantitative, qualitative KPIs, it's social, it's governance, even certain KPIs which could be linked to financial. So the scope in sustainability or ESG, the reporting is very vast. And what is unique here is there is a lot of qualitative information also which gets which is getting disclosed by the company. And when we have gone through the frameworks, and the requirements of the framework, they require companies to make disclosures which are over and above quantitative disclosure. So that again is a challenge in terms of how these need to be audited. It adds a complexity layer when we are looking at assuring these kinds of information. But having said that, as financial statement auditors, what we also have the knowledge and the skill sets which are actually required in sustainability related information also. The skill set of, checking the information from the lens, and we'll cover it from professional skepticism, from professional judgment, from understanding and looking at information from holistic perspective, and getting for evidences, looking out for evidences for whatever is reported. These are the skill sets which even help the CA professionals in doing audit of ESG. There is also a layer, a big investment that needs to be made is technically understanding the subject matter, technically understanding the GHG, technically understanding the climate related disclosures, and there are involving environment experts and social experts in your team. So what is the reality today when if you have to do an audit of ESG? One of the key considerations also is which the teams which will be doing it, which should be a combination of both chartered accountants and assurance and environment specialists, which is the need of the hour. And if you look at even the institute standard, which I'll refer to, which is the institute standard, they have also clearly, brought out in the report itself, the team considers, the team consists of environment and assurance specialists, because the understanding is clear. This cannot be one set of specialists doing, because the information that is being assured is so vast and has very unique characteristics. So therefore, one of the key things to remember when you're auditing ESG is getting a diverse set, skill set of people you will need for doing these audits. So to start off, in terms of the assurance standard where we are, just give me a second. Yeah. Now, in terms of assurance standard, we start with the global standards which are in place. I hope the screen is visible appropriately. Yeah. Yeah. So in terms of the global standards on assurance, so we have the International Auditing and Assurance Standards Board, the IASB, which issues the auditing standards. And so what you look at here on the screen is what are the standards in force as of now on non-financial information. That is the centerpiece. And highlighted in violet are the sustainability or non-financial. They don't call it sustainability. The standard was introduced several years back. So they had considered here all information which is other than historical financial information is what the purpose of getting these assurance standards bought. So therefore, they came up with, there is a standard ISE 3000, which is in force, which is the overarching standard for assurance on any information other than historical financial information. And it covers both reasonable and limited assurance. Having said that, because it's not only for sustainability, it could be used for assuring any other information also. Secondly, given that greenhouse gas, that is what was mentioned in the discussion which Raman took over, that is GHG, when the session which we took. Greenhouse gas is one of the most monitored or tracked KPI within sustainability because of its impact on the climate. And given the uniqueness and the technicalities involved in calculating these emissions, there is a specific audit standard or assurance standard, which is ISE 3410, which needs to be followed if there is an assurance which is being done or an audit is being done. We call it attestation. Attestation is being done for the greenhouse gas statements. And these standards, if you look at it globally, these standards were issued in the 20th century, and these were followed. So while the last 2 to 3 years, there has been a vast developments in India in the assurance standard space, also through the SRSB. Globally, but the companies in India were reporting, especially the MNCs who have markets abroad, were reporting this information and getting it assured also, so the level of assurance would be limited. And these were the marquee companies, and therefore the standard which was used by the assurance providers were these international standards, which was enforced. So the ICE 3000 requires from quality perspective also, it is governed by the ISQM, and therefore it largely has to be CA firms who are able to deliver these audits, and this needs to be followed. Now, in the global space, given that there was not a specific standard on sustainability assurance itself, there was a draft exposure draft which was introduced as ISSA, which is called the International Standard on Sustainability Assurance, very specific to sustainability information, given globally the regulators also understood the importance of this information, and therefore the auditing body worked on this. This standard actually, as recent as this week itself, on September 20th, last week, it has been approved by the IASB board. And as a process, what this means is now the text of the standard will be finalized, and it will be sent for certification, which they have they have a body which is the Public Interest Oversight Board. There is going to be application material issued by early Jan 2025, where they will, on guidance on how the standard is to be applied, and it is expected to be notified early next year. So what is this standard? How is it different from the ISA 3000? Is it's very specific to sustainability information, and it's quite vast in its coverage. It is developed, if you look at it, is developed based on the existing requirements and guidance, which I mentioned in place was the ISA 3000 revised and ISA 3410. There was also a non-authoritative guidance, which was again introduced in 2021, which is on applying ISA 3000, given that there were so many regulations which were coming up. So this ISSA 5000 has even looked at the guidance, which is non-authoritative given in these. And at times, if there is not, there is deemed appropriate, there is also guidance from the international standards of auditing, which is covered. If you go and look at ISA 5000 and you go through it, or even the present ISA 3000, as auditors, you will see quite a few similarities. There are unique points, but there are a lot of similarities which we'll see when we look at the approach and we run through. So coming back to ISA 3000, this is going to be 5000, sorry. This is going to be an overarching standard. It includes requirements and application material for all elements of a sustainability assurance engagement. Any type of assurance, sustainability assurance engagement, this standard would apply. It would in effect replace ISA 3000. So that this will be now the overarching standard which needs to be applied. In case of specific reporting, say on a greenhouse gas statement, if the company is reporting all these disclosures, the assurance provider has to continue to apply ISA 3410. But even when we apply ISA 3410, either the ISA 3000 or when the ISSA 5000 gets introduced, that will be the overarching standard which the assurance provider will have to refer to in terms of their responsibility, management responsibility, while assuring this information. This framework, like I said, is this standard, sorry, like I said, is framework neutral. It can be used for assurance using information which is prepared using any framework. For example, ISSB disclosure, CSRD, ESRS, integrated reporting framework, if the companies, even the CDP report, any information, if you want to get it assured, prepared under any framework, or even if there is an entity developed criteria basis which the information is reported, this standard can be applied. And this standard applies to all sustainability topics. That means environment, social, economic, cultural, all the topics are being considered. And the important part here to note is this is available for use both by professional accountants and even non-professional accountants. That is what has been introduced in ISSA 5000, given that there are in sustainability space, there are a lot of boutique firms or firms who were providing these services, which may not be chartered accountant firms. So therein, given the enormous opportunity and the enormous extent of assurance which has to be done, and there are companies who understand, or firms who were understanding the environment, especially the technicalities of environment, and has been doing these kinds of certifications. Those have kind of represented, and therefore these firms could also, who are not actually professional accountants, could provide these services. But there would be there are conditions around it in terms of ethics and largely the system of quality of management that needs to be complied with, and that's the guidance which is coming. So a lot more coming in this space, which we will cover going ahead as this gets notified. So from global, we move to India. In terms of India, where are we? The Institute of Chartered Accountants has issued Standard on Sustainability Assurance Engagement, SSA 3000, and Standard on Assurance Engagement, SAE 3410, for greenhouse gas statements. It's quite aligned to the ISA 3000 and SAE 3410, but this is very specific for sustainability information. The standard deals with only attestation engagements, and there is the standard on quality control, SOC1, is similar to what you will have in audit that needs to be taken care of. And then you also have the code of conduct, which applies to firms which are the practitioner, is what is called in the standards, who can provide these services. The other piece which the Sustainability Review Standards Board has issued is social audit standards, which we are not covering right now, and that's also a space which is being developing quite a bit, and there are standards issued separately for same. Now, if we look at there are now the assurance standards, if we go a little deeper, which are the unique terms in the assurance standard, which could be which is unique to sustainability. I'll cover a few of them. Now, the standards they require, the assurance standards, use the term underlying subject matter. Underlying subject matter basically means the phenomena that is being measured or evaluating by applying a criteria. What is it that you're trying to measure? And for example, in case of greenhouse emission is what you're trying to measure. That's your underlying subject matter, which you're trying to measure. What is the criteria? The criteria is one of the most important elements in audit of ESG, and it's vastly used. And it's one of the most important elements as you understand even pre-engagement onboarding also, in terms of the decision of to do assurance, given it's unique. The criteria is the benchmark used to measure or evaluate the underlying subject matter. Say, for example, in greenhouse gas, what's mentioned here also, it's greenhouse gas protocol. Now, this greenhouse gas protocol, if you look at it, it's a publicly available benchmark. So its relevance, its independence is much higher. So there has to be an assessment at the KPI level, which the entity asks, whichever KPI they ask for assurance and sustainability space, whether the criteria on which it's going to be measured is publicly available, is relevant, is available to the users of the information to understand it appropriate. Otherwise, their disclosure is required. So we, as assurance provider, have to be convinced that the criteria which the entity is using to disclose the information, report it, and record it is appropriate. So criteria is a word which is a concept which is unique to sustainability. It is in financial statement was very clear. It is the accounting standards under whichever framework we were doing. Here, because the uniqueness of sustainability KPI is there could be different criteria used to measure different information, and therefore it becomes important to evaluate it. And because also it's an evolving space, there could be certain KPIs which the company is reporting, wherein there is a management criteria, and therefore there is a separate evaluation that needs to be done for that. Then we come to subject matter information. Subject matter information is what is the outcome, what you are measuring, the underlying subject matter, what you're trying to measure, what is the outcome of the measurement of their underlying that results from applying the criteria, which is the greenhouse gas statement. So if you look at it from BRSR report, the local bits, the BRSR report, which is the subject matter information, the water disclosure, the waste disclosure, the people training disclosure, etc., is the underlying subject matter therein, which you're measuring through the criteria, which in this case will be the SEBI guidance, and SEBI itself talks about, so for green house gases, it talks about linking it to the GHG protocol, where the measurement is given, and even for BRSR core, which is a mandatory assurance, it gives guidance on how this needs to be measured to a certain extent. So that's the criteria under which you as an assurance provider will test the information. First, the entity has to measure the information based on the criteria, and then we as an assurance provider has to test that it is appropriately measured as per the guidance, which is given, measured, disclosed. And then we have the assurance, which could be both limited or reasonable assurance, which could be provided under this under the engagement. So going a little deeper into underlying subject matter, like I said, the subject matter would be used by diverse group of users with different needs. It may address it may have a diverse underlying subject matters, which may be complex, that needs to be taken care of. And the objective could be, now in this case, while even for assurance, when we combine, we don't assure forward-looking information still, but it could be objective or subjective, and it will be both quantitative and non-quantitative also. It will be financial, non-financial, but at the same time, it could be quantitative and non-quantitative information. And then when we look at criteria, I kind of explain it. These may be the frameworks and standards which are in place as example. So because of the availability of different sustainability framework, there is even difference in, the company could apply, different companies could apply different frameworks for measuring the same KPI. And subject matter information, as we discussed, is the report in which the information that you're going to audit is there, which is your annual report, your regulatory report, a separate report like BRSR. And your information is on this on the information that the entity is reporting, which will be will be as through the SSA 3001. Unique thing also to remember in sustainability, as of now, it's still evolving, is the auditor or the audit practitioner may or may not be doing the assurance on the entire sustainability disclosures. There are disclosures which the entity would pick and choose and say, these are the disclosures under which I want assurance. So there will be there's still a lot of cases where we don't assure the statement as a whole. If you look at even BRSR report, I'm just linking it because we have that mandatory in India. The BRSR report also requires assurance on identified KPIs within it, which is called BRSR core, which are largely quantitative KPIs. And therefore, the BRSR core information which you are expected to assure will sit in the BRSR report, and you'll have to call out that, this is the portion within the entire BRSR report which we are assuring. This is a key element which we as CS actually use it in our financial audit, which is there in both all the assurance standards, including SSA 3000 or the new ISSA 5000, is professional judgment and professional skepticism. Professional judgment is the judgment that we get because of the technical training we have, because of the skill sets we have of understanding the accounting standards. So similarly, in terms of sustainability, for appropriate professional judgment, what would be required of us is to have knowledge of the auditing standard, that is these assurance standard, as well as a certain level of technical understanding of the technical matters is required as leaders of these engagements, and getting on the right resources, that is environmentalists, who could have need to have deep knowledge in auditing. So professional judgment is something we will is very much required when you understand the needs of the users, when you're determining which criteria is suitable, which we covered. So that's where your professional judgment will be required. Understanding the complex interrelationships between and the relative importance of diverse aspects of the underlying financial sustainability subject matter and their impact on the entity's business. Now, when we and determining whether and when we come to professional skepticism, it is the skeptical mindset which is expected as of an auditor auditing both sustainable and financial information, that he evaluates whether, in case he recognizes any unusual circumstances or omissions of information, it's a professional skepticism. Then you decide, is the information which needs a change, or is there a linkage between the unusual omission or across board, and which could be a cause of concern. Professional skepticism is to be used even when we are evaluating the impact of uncorrected misstatements. When we are evaluating overall whether it's, our procedures are appropriate, and the evidence that we are obtaining, the sufficiency and appropriateness of the evidence that we obtain. And from an overall audit perspective, whether the subject matter is free from material matters. Coming back, going ahead in terms of assurance, what are the level of assurance? The level of assurance is limited or reasonable assurance. Reasonable assurance is when the objective of that assurance is to express an opinion on the outcome of the measurement. In this case, say the greenhouse statement, extending the example which have said the company is disclosing its greenhouse gas statement. So giving an opinion on the outcome, which is the statement, by evaluating the emissions against the criteria, which is the GHG protocol in this case. So it's an opinion. Risk, this is where it is very aligned to what we understand in auditors. Risk of material misstatements. Risk of material, it involves identifying and assessing the risk of material misstatement at the subject matter or information level to determine NTE, that is the nature, extent, and timing of test procedures that would be performed to test the subject matter. And we do sufficient DNI, that is design and implementation walkthrough of the process which would be required, and operating effectiveness of the relevant controls if identified, and as part of a DNI we see that they are effective. And thereafter doing a test of details, which would include inspection, observation, confirmation, recalculation, and analytical procedures. So that's the evidence gathering step in a reasonable assurance. Now, if you compare it to the limited assurance, the understanding bit has to be similar in terms of understanding the KPI, the criteria that is being used by the management to measure that KPI. It is the extent of testing that we do is where there is a large difference. The assurance procedures are substantially lower, and then it therefore impacts the opinion. The outcome of a limited assurance is a negative opinion that nothing has come to attention, that the information is not appropriate. Going ahead quickly, if you look at what has to be the overall assurance approach, if you look at this, which is given summarizing what is there in SSA 3000 or ISA 3000, it is what you would be used to seeing if you were doing an audit of financial statements. Also, you have to have your appropriate preliminary engagement activities. One of the key differentiators in audit of ESG would be a step to ensure that the criteria is appropriate and you're fine as an audit firm or as a signing partner on the criteria. Independence check, similar to audit, there are independence checks that need to be taken. If you are doing assurance on a particular framework. So, for example, in terms of BRSR, SEBI has come out with independence requirements, which are additional than what is there in the Companies Act. So for these engagements, sustainability engagements, you have to check in the framework if there are any additional requirements that the practitioner has to be aware before accepting the engagement. In understand and plan phase, which is the next phase, is what we are doing is understanding at KPI level the process in place at the entity, and before that at the overall level. So as financial auditors, we would be having understanding of the controls in place at the company. Now we were looking at it from the perspective of sustainability to manage the sustainable disclosures. What are the controls for managing ESG? Like it was covered when you have your strategy in the earlier session. It is the ESG committee, or you call it by another name, the risk committee handling it, or the CSR and the ESG committee, which we have seen a lot of companies do, managing both the roles. How is it reviewing the goals and targets it's set for itself, or even if it's not goals and targets as of now, how is it managing its disclosures? So the understanding starts from there, from the tone at the top, and then it comes into at the KPI level, understanding what are the processes and controls in place, and then determining even the materiality. The materiality is a tag different here, a bit different than to financial statements, from the sense in the financial statements we are used to having one materiality for the entire financial statements. In case of sustainability KPIs, we have to go a step deeper, where you're looking at KPIs, say in environment also. The materiality for a water KPI could be different from energy, because one, they are reported in different denominations and the circumstances could be different. You could have clubbing of certain KPIs, so for example, scope 1 and scope 2, and determine the unique KPI will have a separate materiality. So that's how it will be different. It will not be one overall materiality, but you could have clubbing of KPIs and determine the materiality at which you will be performing your procedures. And this materiality, as you know, will be very important when you're evaluating the misstatements as identified during the audit process. And then you will have the perform and evaluate, where you're doing the actual testing. And thereafter, you have the conclude and report. Similar to what we have in audit, you will have a subsequent review. You need to do an overall assessment at the year end, overall assessment of the sustainability disclosures. The other information is also mentioned very briefly in ISA 3000. The intent is it needs to be covered. ISA 5000 is covering it quite a bit. So the other information will need to be done. Quality control, similar in financial statement, you need to have a quality control in place, and there has to be an independent review of the information being assured, and conclude the audit. Now, if we go just, this is very brief, in terms of understanding a particular KPI, what does that phase include? What does that phase want us to do is basically understanding the type of business. We have been used to understanding, and going back again to financial, just to give a linkage, we do understand the financial processes, the operational processes of the company. Say it's a manufacturing company, the production process, from the perspective of how this will go and impact the production, the inventory, how there is controls along movement of the goods out, and how the recording goes into the financials. Now, as the sustainability will want it to go deeper on the other angle, in terms of in these processes, what are the kind of emissions that get generated in these processes? What is the sources of energy which is being used? What is the water being used? That understanding is what, when we say understanding the business from sustainability perspective, even understanding what are the systems being used. There are organizations which are using sophisticated systems for their operation, which have underlying linkages to the sustainability reporting. So therefore, understanding the level of automation and the controls and the associated risks therein. The understanding of the IT element, when you do the second step, when you do the walkthrough of a process end to end, is when you understand which is the IT element, which is wherein the information which is feeding into the sustainability KPIs is being recorded, whether it's and running it through GITC, depending on the application being used, and using that system, and if the system reports are being used, getting the operating effectiveness tested, so that the IPE, which is the information produced by the entity, could be tested, or the information used in the control by the entity is, if that is the case, would be tested. So even in sustainability, the expectation is to have a design and implementation, and the controls, the design is implemented, and you find it effective doing the operational effectiveness testing. Practically, I would like to add the operating effectiveness testing in ESG as of now could be a challenge, because it is what you say, it's an evolving space. So the intent of the standard is, but these are the processes that need to be followed, and going forward, that's where we need to move ahead. One of the key elements I thought we'll cover briefly, and which has, which is important when you're assessing any information which you're auditing from ESG, which is from ESG perspective, which I even talk to my colleagues in non-chartered accountant colleagues who are environment specialists or social specialists, which really helps them also understand what an auditor mindset is, and when they are looking at the information, is looking at the KPI from the lens of the assertions, which helps to have a complete understanding, asking the right questions when you are auditing this information and even testing it. So the assertions being occurrence and existence, the disclosures which you are reporting, are they relating to conditions that have occurred even from sustainability perspective, and reported responsibility that this pertains to the entity. Completeness, that all the which means that all the events or conditions pertaining to the entity, pertaining to that KPI within the reporting boundary have occurred or existed or exist and should have been included in the sustainability information. Accuracy and valuation, the disclosures including estimates have been properly measured. When we say accuracy and valuation, or designed in accordance with the applicable criteria. When you evaluate the KPI from cutoff perspective, what you're trying to see is that the disclosures have been recorded in the correct reporting period. When you're looking at presentation, classification, and understanding, which you need to look at a KPI, is ensuring that your disclosures are appropriately aggregated or disaggregated and structured appropriately and presented in accordance with the applicable criteria. In this case, we were seeing BRS, GHG proper, or you have the GRS. So what the standard is requiring, are you presenting and classifying in accordance with the standard? And then when we look at a KPI from the consistency perspective, it is the criteria and the application, whether it's consistent period on period. And if there are any changes, are these justified and being appropriately applied and adequately disclosed? And comparative information is reported in the prior period or has been appropriately restated. So these are the assertions. They are not directly coming as of now in the ISA 3000. This is the SSA 5000, that these are the assertions when a practitioner needs to keep in mind. A good guidance which is coming in the standard. In the interest of time, I'll quickly take two KPIs. If you look at greenhouse gas emissions. Now, when you look at greenhouse gas emissions, which is to be reported, I'm not going into the technicalities. Say here, scope 1 and scope 2, which is, what is the emissions from the energy, the fuel energy, scope 2, and the fuels which is used by the entity. How will you fit in it in the assertions? How would we look at it from assertions perspective? So if for scope 1, you are trying to test whether it is the emissions are complete. So you have to, from a occurrence perspective, you'll be testing that the emission is considering all the assets which are owned or controlled by the entity, because that's the criteria which is given in the GHG protocol. So that needs to be inquired with the management as the measurement is done for all. Completeness is the various sources of emission, all of them considered, the process, the stationary, the mobiles, all of these sources have been considered for fuel consumption for assets which are owned and leased by the company. Leased assets also have an implication, which is a separate topic in itself, but GHG has guidance on GHG protocol on that, on what extent leased assets have to be considered. And then you have accuracy with calculations. We understand whether it's calculated appropriately in cutoff. When you look at sustainability KPIs, what you're trying to look at is what you understand from audit also, with the source stock. When the last booked source document data statement, you have to see that the reporting for the period is appropriate. And just because to show a good picture, the cutoff has not been applied appropriately. Classification is it is an appropriate category. Like I said, here we're saying in case of emission, for fugitive emissions, which is basically the emission from AC and fire extinguishers, which is used by a company, that has been appropriately classified when it is disclosed separately. And consistently, like we said, the methodology used to measure the GHG emission is a consistent period on period. And what are the challenges which we see at times when we are auditing this information, which could be because sustainability, if you see as a space, is evolving. It will take time. Financial statement audit has evolved. So the companies who are reporting sustainability information, these are largely teams either in the energy departments. If they have the HSC department. These departments are used to audit only if they're getting some ISO certification or done, and the level of assurance there is more on the process rather than the data completeness which is coming out. Therefore, there is a journey which the companies are also on in reporting this information in terms of evidencing the control also that they have in place. So therefore, the challenges which we see in auditing GHG emissions which you could face is accuracy of the data which is available. We had one of the companies, it could be that entities, they had energy bills, for example, which was supposed to be recorded. They recorded, because of the period within which they had to record, they recorded energy bills based on their meter reporting, and then what the billing agency gave, the numbers were different in terms of the kWh consumed. So the accuracy of the information which is to be recorded is at times inaccurate, and we have to kind of give guidance. Calculation methods, they are used. The calculation method is available in quite a few cases on the GHG protocol, but at times companies could adopt methods which are not appropriate, and therefore calculation methods is key. Consistency and consolidation of data. Consolidation of data is a big challenge, because a lot of companies, they will have the environment KPIs being recorded in a decentralized manner and then collated in Excel by the centralized team. And there are, like I said earlier, there are denominations in which the information has to be reported is different. Therefore, the challenge it happens is the denomination is not right, or the capturing of the information from the source document is not of the right denomination, and that could lead to a lot of challenges when you're consolidating. Use of estimates, what we in GHG and in other KPIs, at times there are factors which are used which are globally available benchmarks like the IPCC, the DEFRA. What is important to use, that the estimates or the conversion rates which are being used are used from the most updated regulation. At times this gets updated. What we have seen in audits, companies do not update their source information basis which these calculations were then, and the estimates were inappropriate. And the changes in reporting methods, because sustainability is evolving, there could be changes in the way the calculation is made year on year, and that it should be justified and it should not be just for the benefit of the disclosure. I quickly cover water. Similar things to keep in mind in water, in case of water withdrawal, which is one of the KPIs which gets reported across a lot of frameworks, is ensuring and testing across these assurances, whichever disclosure is being made, to ensure that it is being reported appropriately. And what is the challenge is that entities, when they consolidate the information, the underlying records at times is not appropriate. The logbook. So we had a case where the logbook was showing a different water withdrawal, the bill was showing a different figure, and what was reported in the Excel was a different figure. So there's a lot of challenges there, because there was a lot of manual intervention. The experience of reporting this information at all the locations in which the entities operate was not complete, and therefore, as an auditor, we had to be much more skeptical when we are doing these audits. One of the points that I have not kind of covered is very important to note is in a lot of this, when you understand this sustainability information, is that, there could be other compliance or operational controls which companies have and they report. So for example, in case of water or even electricity, there is something called a consent to operate. So whenever a plant is set up, or even if you're putting up a campus, there is a consent to operate which the company obtains, wherein it is clearly stated what could be the sources of water which is permissible, how many DG sets are permissible for a company to put in. And that is an auditable evidence, which as an auditor we should look at first to see that the completeness of the information is appropriate, the classification of the information is appropriate, and there would be a lot more such environmental regulations and the compliances that the company needs to move, which could be a source of evidence to corroborate that the information that they are reporting. In social KPIs, quickly to cover is, you have employee well-being. This is the BRSR core one, which I've mentioned, that employee well-being and safety is a KPI, especially safety, which across all frameworks require its disclosure. It's largely from the perspective of, worker norms that, do you have safety processes in place to ensure that the lost time injury is reported appropriately. Largely, companies would have, especially manufacturing companies, do have processes in place because this is very critically evaluated and manned information. But what the challenge you could face is at times, the recording and the evidencing of it becomes a challenge. Here again, there are, depending on the Factories Act, if it's a factory, there is a reporting that needs to be done in separate forms, which could be different state-wise, which could be used as an evidence to say what is the incident being reported and what is to the regulator and what is being reported in the sustainability reporting. There has to be evidence of the mechanism of tracking the injury and then reporting it. One of the key elements which I want to kind of end with, given in the interest of time, is a lot of the information when you will see and you audit, what you need to keep in mind in ESG, it could have financial linkages also, if not directly, indirectly. So for example, in lost time injury, which I said, it is per million hours worked, you will have the number of employees which is being considered as appropriate. Now, if the company is having a very granular process, they could be doing it, a month basis in terms of the attendance tracking of the workers or the employees coming in. So there, and the same system is something in financials, the company, the auditor could be looking at it when he's testing his payroll cycle. So if there are a lot of linkages, which I want to say, between the financial and even non-financial information, which needs to be assessed. Lastly, what I've tried to summarize, what are the challenges under assurance which auditors face is understanding of the reporting framework. At times, the companies, the frameworks are evaluating the people at the ground level have not an understanding of the framework and the requirement, and therefore could be a challenge in that the reporting is not appropriate. Data availability is not being tracked, and therefore it is not accurate. The calculation methods used may not be consistent, may not be accurate, or maybe and especially in case of a management developed criteria, we had companies who report on carbon sequestration, which is a highly complex area. So is the calculation methods appropriate? You might have to use environmental experts to test this. The estimates used, there are companies which are in processes, have process emissions which are unique. You don't have a benchmark. So how do they, measure this? Is the measurement appropriate or no? That is going to be critical. And the reporting templates is where there is a lot of scope, where the information is not standardized in terms of reporting, and therefore it could be difficult for us as an auditor to audit it. And I'll end it here, and over to the hosts for the questions.
Thank you, Raman ji and Priya ji. It's been an absolute privilege to listen to such an insightful and engaging presentation. So, we have a couple of questions to ask. Our first question is, what is the applicability of ESG audit in India? Who is eligible to be appointed? And are there any available certifications for ESG?
So in India, if you look at it from in terms of reporting mandatory and getting it assured, it's the BRSR, which is applicable from reporting perspective to top 1,000 listed entities. The SEBI had come out with the regulation in July 23 in terms of it gave a glide path when will the assurance be applicable. Last year, it was applicable to top 150 listed companies on the BRSR code, which is a carve out of the BRSR disclosures on a reasonable basis. This year, that is 24-25, it will be top 250 companies, and next year 500, and then and the balance companies. But what is very important to note is also that SEBI came up with a consultation paper, it's not still notified, where they are proposing, given that I guess it's a feedback from the corporate world also, of the rigor of reasonable assurance and the availability of information. There could be a limited assurance which will be allowed to the companies to adopt. And there is also a term assessment which SEBI has used, which needs clarification what they mean. So at present, this is where we are in India in terms of framework and the applicability. In terms of who can provide this assurance, BRSR has certain independence requirements, which if it is met, it is not limiting it only to the CA firms, even the non-CA firms that can provide this assurance if you meet those criteria.
I have another question. Like with the rise of ESG reporting requirements, there's one issue that we face quite a lot. Like it's been highlighted many times, like accounting for carbon credits. Could you throw some light about what are carbon credits and how do we need to account for them?
Aman, you want to cover that? Carbon credit?
Yes, let me cover that. So carbon credit is similar to what is happening today is that whenever company want to go carbon neutral, there are two ways of doing carbon neutral. One is they set up processes in a way that they try to reduce carbon emissions from their own processes, from their maybe setting up those processes like buying those equipments which are carbon neutral or which are contributing to those. The second way is buying a carbon credit. Buying a carbon credit would mean investing on those carbon credits by somebody who has initiated those steps. Like there are a number of organizations today who are authorized to they have accumulated carbon credits because they are located in those regions whereby they have generated carbon credits, and hence you pay them and buy those carbon credits. So that's how carbon credit is. The second question relates to accounting. I'm not sure whether how should that be done, and if there are any specific regulations. Maybe Priya, you would know if something has been specified there on regulations for carbon credits.
So not
It's
in India, I think it's
yeah.
evolving. What we have seen is the depending on the enforceability and the acceptance of carbon credit is your disclosure, right? In your scope 1 and scope 2, when you're disclosing the emissions, depending on the carbon credit that you have, kind of carbon credit you have taken, the emissions could be netted off and disclosed both absolute and also and otherwise.
SE 3410 that you mentioned about, that also mentions something about emission credits. Are those the same as carbon credits, or is there a difference in that?
So that, we'll have to see. See the credits business, and I think Raman will add more, the carbon credit and the offset is very tricky from the perspective that it should pass the test of it being appropriate. And there are, not the auditing standard is the right space. There are standards which are evaluated. Actually, there are external agencies which measure these, if it is internally generated. If it's an IRAC which you're purchasing, like Raman mentioned, then it has its own, because you're paying a cost for this. And there is an agency who has generated, and it's verified. So it's an external verified agency which will give it credit. Yes, emission credits could include carbon credits also from your perspective.
Yeah, but this is carbon credit is one of the most trickiest topic in ESG. At least I would say, because of not we don't have much clear guidance, especially on the accounting domain. We don't have. So maybe companies might go and apply to different IFRS and may apply different kind of accounting treatment there. So it could be either you say it's an intangible asset because it's helping me to cover my risks somewhere, or some companies might expense off as well, or they might cover in some different standards. Somebody might say it's an investment for me. So no specific, I would say, clarity at this moment. But as we evolve, we'll definitely see something coming soon from, whether it's from IASB or FASB, we'll get to hear something soon. Yeah.
So my next question is, what could be the key differences in the way the auditor approaches ESG audit versus the financial audit? Is there a way he can leverage his financial audit procedures for ESG as well?
Yeah, definitely. You are leveraging the financial audit for sustainability audit, but in certain KPIs you will be able to leverage. If, for example, so for example, in case of employee training, like I mentioned, or employee related KPIs, where the employee count is something that you're covering, the existence of employees is something that you're covering as part of audit. But training per se in financial audit doesn't get that rigor, because it's just as a cost, which may at times, if its material gets tested, but the count of the hours and the type of training which the sustainability audit sustainability disclosures require is which you'll have to do incremental testing. So yes, there will be a huge leveraging, could be, but depends on the KPI. One of the most important matters which I thought where they could be, depending on what your company is using, is the GITC. As part of audit, you do test IT elements. Now, if the company is using the same to disclose or to record its information, especially in large complex organizations, manufacturing organizations, where the processes lead to the same output, lead in the same database where the financial is there and that's covered, that is something that you can leverage on. So it does make sense for a financial auditor to, obviously have another team, but there could be a lot of synergies.
Yes, and maybe if I can also add there, because a financial auditor normally has access to almost all the processes in an organization, be it any process, have at least a fairly good understanding. So that way he can always leverage that expertise, he can always leverage that knowledge um, within the company and utilize those. So I would say yes, to an extent, as Priya also mentioned, it definitely adds value. If you are an auditor of a company, you'd be knowing much more about that company and can definitely link it across the board through all the processes and procedures there.
Okay.
So I have just one more question. Like we talked about GHG emissions many times during the presentation. Like they also mentioned like we have different categories: scope 1, scope 2, and scope 3 emissions. And BRSR also required separate disclosures for these. Like, is there any way to bifurcate? Is there any guidance on that, or like, do you have any examples? What should be included in scope 1, scope 3?
Again, give a brief, and then I think Raman will be able to go detail with specifics. So scope 1, in terms of basics, this again is a topic in itself, and the limited knowledge, I'm not an expert in it, but if you look at GHG protocol, it gives a detailed guidance on this. Scope 1, simply put, is the emissions from the assets which is owned or controlled by the entity, and therefore a very simple example is of the vehicles which is owned by the company, and there is emission. If you're a manufacturing unit, the plant and the process that you do, emissions out of that is a scope 1. Scope 2 is all the energy which is consumed, which could be direct, indirect. You're purchasing energy and using it. So scope 2 is the energy consumption of the entity. Scope 3 is a different ballgame altogether. It's everything else which has 15 categories in your business, in your value chain. What are the emissions that company, because of the company's production or providing services, also if a company service, what are the emissions being generated? So for example, again a simple example would be an employee commute. The employee commute which an employee of a company is doing from his home to his office workplace, the emission depending on the vehicle which he's using is a scope 3 for that company. There is business travel, which an employee is traveling to another client place just for the company's business, is business traveler category. I mean, this is simpler. There are a lot more complex category on purchase of goods and services for finance companies, finance investments. So these are the three categories, and the guidance is in GHG protocol. Raman, you want to add something, key which will help the listeners?
I believe you have covered the piece well in terms of what is the difference between scope 1, 2, and 3. This is my understanding. What I have seen most of the financials that I read, their sustainability statement that I read, I see scope 3 being the most significant of all in terms of percentage. Maybe I can quote around 80 to 90%. And some of the organization, it's even more than 90% at scope 3. Because scope 3 is about value chain. As I mentioned in one of my slides, it's about upstream, it's about downstream. It's about what is it, how much emissions my suppliers, who might be MSME, all of them have emitted, how much emissions my customer from use of my products, if I'm a B2B business, have emitted. So it's I would say very, very comprehensive, and scope 3 is what creates a big challenge for companies to collate that information and then at the end of report, because they are ultimately not responsible for scope 3. Imagine I am just reporting, or I'm just looking at the information of somebody whom I'm not owning it well. So there are always chances of errors and misinterpretations, or the kind of judgment differences that might happen. So it creates definitely a big kind of differences or a big challenge for companies to report.
So like scope 3 could be the indirect impact.
Yeah. But as you know, right now companies are expected to control their scope 1 or scope 2. Scope 3 is also an expectation, but it's it's a journey which will have to be done.
Yes,
because you as a
exactly.
purchaser, or have some power actually over your suppliers. Customers is an even bigger challenge. I don't know how customers you will ever be able to enforce
Yes.
sustainability. It's going to be a challenge. It's your suppliers to a certain extent, through your suppliers codes, through your policies, you try and enforce and get better emissions. Therefore, you see, companies are going green. Real estate guys are going green. They're not going green just because because the business gets impacted.
Yes, exactly. And in fact, this speaks in the regulation as well. And I'll talk about US regulation. US mandated scope 1, scope 2, scope 3 as mandatory. But then because of industry lobbying and that pressure, they had to withdraw. They kept scope 3 as optional. California today even has scope 3 as optional. So we see these as most of those everybody is facing exactly the same challenge, and hence scope 3 is considered to be taking time in terms of reporting, in terms of data collation, in terms of consistency. So yeah, let's hope we'll be able to have information. Yeah.
Thank you, Priyaji and Amanji, for addressing all our questions. So now I would like to invite Anilji for the vote of thanks. Anilji, are you there? Anilji, you are on mute. We can't hear you.
Yeah.
Can you hear me?
Yeah, we can hear.
Can you hear me now? Okay. Thank you so much. It was wonderful deliberation. Due to the technical glitch at the last, I was not able to join for 10-20 seconds. So it was wonderful deliberation, Ramanji and Priyaji, and we have gained a lot through the both of you's deliberation. And more than 500 members are live at this particular time, and I hope our members have gained a lot through your deliberation. So on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, once again I extend my heartiest thanks towards both the learned speaker Ramanji and Priyaji for their valuable time and expertise which they have shared with all our members. Thank you so much, ma'am. Thank you so much, sir. I also thanks both the moderators for today's webinar, Mr. Shan and Ms. Nikita, for wonderfully coordinating the webinar and moderating the webinar. Thank you so much, everyone. I also thanks all the participants of today's webinar. Thank you so much. Namaste.
Thank you. Thank you so much.